Hello and welcome back to another lesson. I hope you are well. Today, in this one, I want to talk to you about our trading range, how to identify our trading range, and what to do with it with regards to taking these opportunities. Now, the fact of the matter is, we need to identify in price if we are looking to move higher or if we are looking to move lower. And we need to be able to identify if price action is basically bullish or if price action is bearish. Now, in a bearish movement right here, we want price action to come back into a certain area. And then we want price action to basically offer us a trade position in that area to take us in our intended direction. And just a progression from the last lesson, when looking at price action reacting in areas of inefficiency, and we are looking to target price action towards this area of liquidity. That's called sell side liquidity. And this is price action rebalancing into another area of inefficient price action right here. Likewise, if you see price action trending lower in this example right here, we want price action to push a little bit higher into this area, and we want price action to react from this area of potential inefficiency, targeting this area of liquidity that you see right here. Now, identifying our trading range is the first thing we need to establish when it comes to this particular area right here. But what we have to first and foremost do is wait for price action to give us a couple of things. The first one is that we need a high and we need an established low to be created. Now, to do that, we need something called a three candle formation. So this here is basically just three candles which are next to each other right here. And this isn't going to be the prettiest drawing, but I just want to show you it. We're looking for three wicks to be presented on these areas as well. But the thing we need is that we need the middle wick right here of the three candles to be higher than the two wicks either side of it. So basically, if we see something like that going on, we do not have an established high. We need to wait for something like this to happen here. Now, the same thing applies for the bottom side for us to have an established low. We really could do with price action creating three wicks, and the middle wick is just a wick that we want to end up with lower than the two wicks either side of it. And again, if you see price action creating something like this, that is not an established low. We would assume price action will continue moving lower until we have an established low. And then when you see price action starting to push higher from this area here, at that point, you can start considering if there's an area of inefficiency within this established range, which would basically be this established high and this established low. Now, we want to make this as high in probability as we possibly can. So let's just say we have identified a trading range. There are a couple of things we need to consider with regards to this trading range. Is this a normal trading range, or is this something called a dealing trading range? That is basically where you have price action presenting you with some sort, that was a rubbish drawing, I apologize, with some sort of liquidity grab. So we want price action in this example right here to sweep liquidity, as it's clearly done, aggressively move lower and sweep another area of liquidity for this to be considered a dealing trading range. Once we have that, we identify our swing point high, our swing point low. We now have a trading range. Inside of this trading range is where we're going to look for opportunities. But where are we going to be looking for these opportunities to present themselves? Well, from the last lesson, we did areas of inefficiency and we've also done order blocks. So we can obviously start looking for areas of inefficient price action. We can also start looking for order blocks for price to react from and things like that. These are key areas where price is likely to return to, rebalance into, and then react in its intended direction to the downside. But there's something else we need to add with regards to this to make this a lot higher in probability. Because if you find an imbalance down here, for example, this is not going to be very high in probability. This is going to be very low in probability because we need to do something, and that's called measure this particular trading range. Now, in my Dropbox here, I've got fib retracement. If you don't know where that is, you can go to your trading view on the left. You can see Fibonacci. You just want this top one here. I favorited it, which puts it in my box here. So basically, when I click it, I can click at the top anywhere. I can drag this along. And all the Fibonacci tool is doing in this example is measuring from where I started it to where I finished it in that example there. So that is 50% of this line I have just drawn. If the line was a lot bigger and I want to measure 50% of this particular line, I'm going to take this all the way down to the bottom right here, and that is 50% of my line. If I bring that all the way up and I decide I want to measure that line, you can see it measures 50%. In terms of fib settings and things like that, I'm going to give all of that to you, so don't panic. But for the sake of what we need to do now, we need to measure our trading range to find a high probability area of imbalance. So from the top, we clicked our fib range right here. I'm measuring from the top all the way down to the bottom. This is our trading range, our dealing trading range. We've had a swing high, a swing low. We've started pushing higher. We've now measured the range, and we can note 50% of this particular range right here. Perfect. Okay, there's 50% of my trading range. So because I've got this line which gives me 50%, I'm now ready to delete my fib retracement setting because I want to keep this chart nice and clean. So we know this is 50% of the range. We want price action to retrace up to 50% or higher before coming lower. Because basically, when price returns to at least 50% of the range, that is entering a certain area on the trading range. And that is called, in this bearish example, by the way, this is a bearish example, that is called a premium area. And the zone below 50% of the trading range is called a discount area. These are two different areas. I'm actually going to delete these swing point levels here. If you want to go back onto these levels, please feel free to just rewind the video. So that is price action coming into 50%, as you can see right here. And again, I'm just going to delete that. And then we'll be able to see, this is where we want to see. So we are looking to identify areas of inefficient price action inside our premium area. Now, if I was to invert this chart right here, we are still looking for price action to come into 50% of the trading range. But this time, this would flip. We want price to come into a discount area because the bottom is going to be the discount and the top is going to be the premium. So basically, we are looking to buy inside a discount area, which is going to be below 50% of the trading range. And I appreciate that's gone miles away. And my spelling again of the trading range right here. And then we want to sell in the premium area, which is above 50% of the trading range. So if we have these areas and we identify our trading range, our dealing trading range right here, and we are then able to identify inside our discount area and inside our premium area whether or not we can take these positions, these are high probability areas of inefficiency, meaning we can look to enter within here, or we can look to enter within the order blocks. These are where we're looking for these opportunities in a bearish environment. Again, let's flip this back right here. And let's just change this back here because now we've flipped this here. This is a bearish example. We are not looking for price action to come into a premium area in a bearish market. We are looking for price action to come back into a discount. Sorry, we're looking for price to come into a premium area. And this is actually now flipped. So inside our premium area, just to start things off, we are looking for imbalances and order blocks. And inside our discount area, once again, we are looking for imbalances and order blocks because that is going to give you the highest probable situation that you will be able to see. So if you see an area of inefficiency, you've identified a trading range, you see an area of inefficiency in a bearish environment, you see it here, then that is not a highly probable area of inefficiency. We are looking for areas of inefficiency higher up. So if we come to this level right here, we can see that price action has swept this area of liquidity. You can see right here. It has also swept this area of liquidity here and aggressively moved lower. We have the middle wick here, and then we have the two either side of it. So that is our established high. So we can call that a high. Now price action comes lower, comes back into this in a huge area of inefficient price action, then drops again. We have this candle right here. This one right here is too high up for us to be looking at that one next to it. We need these candles to be reactive close to it. So then you can see the next one here. That's not really a very good considered swing low for me. And as you can see, price action pushes higher, drops lower again until we get one candle, two candle, three candle. This middle wick right here is lower than the two either side of it. So that is an established low for me. Meaning we can look inside of here for potential opportunities. Now, there's a couple of things, and I'm just going to reverse all of this just to make this a little bit cleaner. There's a couple of things I'm looking to do inside of here. First things first, we've identified our dealing range. We've identified our dealing range. Great. So now we're in a position where we can measure our dealing range. And I'm going to go from the top. I've just clicked on the bottom down here on my favorites. Again, if you can't find it, it's on the left, this little arrow in there. Favorite it. You're going to use it all the time. I'm going to measure it from the top. I'm going to come all the way to the bottom, which is the swing high to the swing low. And then I'm going to measure 50% of this particular range. You can then see, I should put that right on the 50% line. You can then see that is 50% of the trading range. Now I've got this level. I can delete this just to keep my chart nice and clean. Again, this is a bearish example right now. This is a bearish example. Price is moving lower aggressively to the downside. So I'm looking if price action is all the way down here. Let me just, for the sake of here, let me just kind of delete all that. We are looking for price action to come higher, above 50% of this particular range. So we've now measured it. I don't want to measure it again, but when we are now looking for opportunities inside this area right here, and I've measured from 50% all the way to the top because that is a premium area. And in this valid trading range from 50% to the bottom right here is going to be your discounts area. So you can see a very, very, very large area of inefficient price action from that level right here all the way down to this level here. And this is the thing, a lot of people are going to get confused on this, but I'm going to clear this all up. This is a huge area of inefficiency. So there's a couple of things you can do. You can measure 50% of that imbalance, and you can see within this area right here, 50% of that imbalance would easily be fine. You could take a position there for a sell, whatever, fine. Or you could wait for price to come back to this order block potentially, because inside this area, we're looking for order blocks. We're looking for areas of inefficiency in our dealing range. And we have a valid order block, which is right there. That's the last up candle before price moves lower, as we've done in previous lessons. But I would like to go a little bit deeper. If we now start seeing what this trading range looks like from the inside of this range, we need to kind of dissect what is actually happening on this particular range. So we have our time frames. This is a 4-hour time frame. If you go down to a 3-hour time frame, you'll be able to see price action looks very similar. If you go down to a 2-hour time frame, you'll be able to see that this area of inefficiency is actually a little bit smaller now. So this is going to give you a refinement of your entries. And if you go down to a 1-hour time frame, again, you can see this area of inefficiency is a little bit smaller. So this now is an imbalance that we can start working with, because we have inside our premium area, we have imbalances and we have order blocks, which means we can potentially look for setups inside of these particular areas. And you could take a position based upon that. And you can see that price action spent a little bit of time just kind of putting this into real here, all the way back into these areas before dropping lower. Price action didn't quite make it to this order block, but we almost filled all of this area of inefficiency before price action made it on the way down. And you can see once that happened, and this is the part of trading I absolutely love, price action started to create more areas of inefficiency right here. And hopefully you should be able to see that price action is just respecting these areas right here before moving in its direction. Because you can see here, we created another area inside of here, inside of this bearish range. And we created that and we targeted this low right here, which is what? Liquidity in the market. Price action recycles through all this all the time. Price action will always travel from discount to premium. It will then create another range which you can identify and see if we can measure the next level, and that is going to give you your premium and your discount. You just need a couple of things to play out: your 3-point candles, your range, your premium area, your discount area. Is it a dealing range? Is it not a dealing range? Is there an area of imbalance inside of it? We know that is our 1-hour imbalance. So we've refined that imbalance basically. And what that basically means is you are going to take a position. If you took a position at 50%, for example, and you were targeting this area right here, your stop loss would need to be above the high. Now, this isn't going to give you a good, what we call risk reward. And we're going to talk about this at some point. But you're entering at 50% of the range. Now, if we can refine our entry to this area of inefficiency here, you will be able to see that the risk reward is looking a little bit better. So for the 1% I'm risking, I'm getting 1.76% back. But ideally, we want to go for a little bit better than that. If we look at this 1-hour imbalance, and let's just say we took an entry on the middle of that imbalance, which is 50%, we could see we took the entry right here, and we're getting 3 times our risk back, nearly 4 times our risk back for this particular entry right here. That is basically just using the trading range and the premium area and the areas of inefficiency inside of it, knowing that the eventual target from this area of inefficiency that we've identified on our trading range is targeting towards liquidity. This is now, what we're doing now is we are in the making of creating higher probable traders. Okay, you can see price action came into this level here. You can see and identify, and just doing this here, if I just move this just to keep this clean, price action swept this random high right here. Great. Price action then inside this area came lower, created this swing point here. Price action pushed higher, then came down. But this isn't really an ideal swing point. I don't particularly like that swing point because, again, this wick right here, the next one is this one all the way up here. So again, price action come a little bit higher, then started moving lower. We created a swing point here. Okay, but this is what we have to try and identify about price action. If we are to measure the trading range here. Firstly, you can see we never made it to 50%. Even though we created this low, that could have been your trading range. Let's just say, for argument's sake, you've identified this new trading range from this level, which swept liquidity, to this one right here. You can see price action never came to 50%. It actually continued moving lower. If that's the case, you've not identified the full range yet. Now we're looking to identify our new swing low because we've got a swing high. We're now looking for a swing low. We've got a new area and we've now got a new level, a 50% level, which is right here. That's 50% of your trading range. You can see the price action come all the way up into this area of inefficiency and almost up to the order block as well. Inside this level to then give us a move to the downside, targeting the liquidity that was created in price. And once again, this is a higher probable trade than this one because you've had the evidence to support it from this particular area, because we've already had the reaction out of here by creating another trading range. So again, your trade opportunity could have been anywhere in here targeting. You would have had your stop loss at the top of the range, targeting this new level of liquidity. Just entering at the open of that imbalance would give you a 2-to-1 for your money back. If you entered at 50% inside another imbalance, you're not going to get anything back. But we can see there's a clear place for price action to go towards, which is going to be really, really powerful for you. So once again, even if you go back into this here and you put the middle line back on and you say, I want to enter at 50% of this particular range, you're going to get a 3-to-1. Imagine if you took 2 trades risking 1% each. There's a 1% risk here and a 1% risk here, both on 3-to-1s, both hit take profit, meaning you've got 6% back. You're 4% away from a funded account challenge based on this model here. So this is just a little insight into how to identify your range, what we're looking for, premium discount, things like that. Go and do some homework. Go and do some back testing. I'm not going to release the next homework block yet because, again, we need to cover a couple of things. But hopefully you enjoyed this lesson, and I will see you on the next one.